Over the past 44 years of option trading, I've developed and refined a short list of essential skills that traders of all skill levels must have to achieve optimum results. As a professional option trader, I place more than 10,000 option trades each year, but I've also helped hundreds of thousands of traders who either call into our daily show, email us, write to us. So whether you're a beginner option trader or a seasoned professional, get ready to learn the 6 must-know skills for active traders.
So what you're going to see here today is quite unique. You're going to see 6 different speakers, all about 20 minutes apiece, talking about different areas of building a portfolio. And hopefully, by the time you see each one of us, you'll be able to answer the questions that you see here on the screen. So for myself, you'll hopefully be able to answer, what is the first step when you're talking about building a portfolio? After that, what is my statistical edge after you hear from Mike Butler? Next, what are the tools when you hear from Katie McGarrigle? As we move to the next part of managing portfolio, what am I trading when you hear from Nick Batista? And then how do I elevate when you hear from Pete Molmat? And finally, Tom Sosnoff is going to bring it all together, everything that we have said, and answer the question, how do I build a portfolio? So the first thing I'm going to discuss is liquidity. Anytime you enter any trade, liquidity is of the utmost importance. You need to be able to get in and get out of a trade. I mean, that's the only way you can essentially make money. Obviously, you want to get in at a lower price and get out at a higher price. It doesn't matter if we're talking about stock or if we're talking about options. Evaluating liquidity is the most important and first step of a trade. How can you evaluate liquidity? One of the ways is looking at narrow bid-ask spreads, whether it's between stocks or those option spreads. You need to be able to find a way to get in at a very low cost to yourself and be able to get out, obviously at a better price. But to be able to get in between those narrow bid-ask spreads is most important. So look at narrow bid-ask spreads, look at volume and open interest on any given line of options that you're trading. That gives you an idea of how many people are interested in a very similar trade. So you want to see high volume and open interest along with those narrow bid-ask spreads. One of the ways we try to make this easy for you is on the tastytrade platform. We provide a liquidity meter. As you can see on the right, you'll see poor liquidity, obviously with 1 star, and it gets better as the stars go up, with 4 stars being the highest liquidity. Next is product diversification. Now, when you're building a portfolio, you want to have multiple things in the portfolio to sort of offset risk, which we'll get to a little more later. In this case, when we're looking at different areas of the portfolio, first, looking at in a very actively managed portfolio, in an options trading portfolio, for the most part, you'll see it's 50% options, right? And this is typically with equity options, whether it's index options or just different equity names, 50% of it will be options. Next, you'll see about 20% of that will be futures, right? If you're talking about currency futures or bond futures or commodity futures, and not only just those futures, but also probably those futures options, right? Sometimes you're trading those futures options because they're just a lot less buying power than the actual future itself. So 20% of that will be futures and the futures options associated with it. Next, there'll be about 20% stocks. And often people wonder, well, why would I do stocks, particularly when most of you at tastylive are talking about options all the time. You know, sometimes it's just a little bit easier to get into a stock as opposed to the option itself. Sometimes, you know, there could be a name that is very low priced, and it's actually cheaper to trade the name with a margin account than it is to trade those options. Or you just might have a name that actually has a dividend, and maybe you want to collect the dividend, right? So sometimes having a stock position isn't such a bad thing. And finally, and probably one of the more debated things, is the amount of cash that you have in a portfolio. We're very transparent here at tastylive in that we never know which way the stock market is moving. We may talk about what direction we think it's going to go, but none of us really know. And that being said, for the times when we have big drawdowns, you want to make sure you have a decent amount of cash in your account to be able to act upon those great trades that just show up every so often and not all the time, right? So sometimes it's 10% cash, sometimes it's 15, sometimes it's 20. Again, these are all guidelines that these numbers are. This is what we see in most active portfolios. You can certainly do it however you want to make sure it works for your portfolio, but the cash number, I think, varies sometimes from anywhere from 10 to 20%, and it behooves you to have that because you just never know when the good opportunities are going to come up. Next is correlation. This is something that varies quite a bit at times given on what's going on in the markets. It really depends on the type of regime that we're in volatility-wise. So what we always look at is correlation between -1 and 1, right? -1 being something is completely wildly off the charts, not correlated to any one asset, and 1 where it's the highest correlation as possible. So when we look at example correlation to the ES, the S&P 500 futures, you can see on the chart here how certain things stack up. NASDAQ is next, NASDAQ futures /NQ. At the time that we put this together, you could see had a 0.9 correlation about 90% of the time, right? If ES is moving in one direction, NASDAQ will likely move in the same direction. Russell 2000 futures, RTY, are next with a 0.73 correlation. Very somewhat correlated as well, right? If ES is moving in one direction, RTY and Russell 2000 will likely move in another. Now, what we've seen recently at the time of this recording, a lot of times it will vary. Sometimes we'll see Russell 2000 sort of flip the other way, and that's mostly because of what's going on in our current environment when you're talking about inflation coming out of the system and potentially down the line looking at a recession. Next, you'll have bonds /CB, 30-year bond. Now, that's really not that correlated to the S&P 500. It's almost moving in the other direction with a very low correlation of 0.14. Gold /GC is another one that's really not that correlated to equity markets for the most part. We see this often. Typically, we'll move in it on its own. Oil is another thing. As you can see here, we start to get to a negative correlation with oil because for the most part, they don't move with equity markets. Natural gas, wildly uncorrelated to the S&P 500 futures and NASDAQ futures. Typically, they do their own thing. And then finally, at the bottom, we have one currency in the form of the euro /6E, which is about a 0.41 correlation. Because we do somewhat see a type of weird correlation with the dollar, and so there is a correlation between the euro and the dollar. So this is really important to know how things are correlated in your portfolio because you want to get an idea of how susceptible your portfolio might be to what we call black swan events, where things happen out of the blue and markets are down several percentage points, right? If you know the way that your portfolio is going to react and you're aware of the type of volatility that your portfolio might have, it helps you better prepare for how to manage risk in that portfolio. Another thing to really look at with regard to correlation, the way we can do this and get an idea of how everything will move together is beta-weighted deltas. Beta-weighted deltas is a way of matching up everything in your portfolio and having an idea of how correlated they are. And the way that that's done is beta-weighted deltas typically will weight any given product in your portfolio to the SPY, the S&P 500, right? If you have beta-weighted deltas of 100 in your portfolio, that means that you have 100 deltas of SPY. And if SPY is trading, say, 550, well, then you have $55,000 worth of SPY in your portfolio. So you would like to know how much that number is compared to your actual size of your portfolio. Let's just say you have a $5,000 portfolio. If you have 100 beta-weighted deltas, well, then easily you have about more than 10 times the amount of SPY in your portfolio, which could be quite massive and could lead to volatility more than you want within your portfolio. To further explain my point, we have a chart here that's showing what the daily volatility of any given portfolio is depending on the type of portfolio you have. So let's just say you have $100,000 worth of S&P 500 in your portfolio, and your portfolio moves plus or minus 1.2% on any given day in your P&L, right? Let's just say you have a different portfolio that has $100,000 worth of bonds. Now, these probably are longer bond maturities, anything longer than 10 years. Bonds are typically a little less volatile than equities, and so, as you can see here, that daily volatility of that portfolio will be plus or minus 0.7%. What we've found from our research at tastylive is that instead of just having $100,000 portfolio of either one of those two, if we combine the two by half, and let's just say $50,000 worth of S&P 500 and $50,000 worth of bonds, we actually reduce the volatility in the portfolio significantly. As you can see here, for an example, it would be plus or minus 0.72% of that portfolio with half and half. So it's important to understand how correlated the different instruments are in your portfolio and being aware of your beta-weighted deltas on a day-to-day basis. Next, when you're building a portfolio, you want to be aware of the duration of the different trades that you have in that portfolio. You don't want to have everything all in near term, right? that's a lot of sleepless nights because you're going to see the volatility in your portfolio vary quite a bit. And you also might not be able to recoup any potential losses. A lot of people like to trade near term, but again, near term ends very quickly and the decisions are made decisively. And a lot of times we don't like to trade the near term too much. We like to be in a certain time frame, which I'll get to in a second. So what you want to do is sort of layer durations at times. It's fine to have a few near-term trades, but you also want to have a few medium-term trades and maybe sometimes a few further out trades depending on the way that you are looking at the markets. There are advantages at times to managing trades early across different durations because as you get closer and closer to expiration, things can change wildly and I'm not sure how your portfolio might react. So you want to have different durations across your portfolio. Adding durations can increase your optionality. If you're looking for a trade to, say, move to the upside and it's been downtrodden for some time, you might want to give yourself time for that trade to work. So instead of 30 days out, you might want to go 40 or 60 days out. Just really depends on how long you think it's going to take for that trade to work. And then finally, taking advantage of the decay curve is probably one of the most important things you can do, particularly for those who are option sellers. Lucky for you, at tastylive, we've done a lot of research about the decay curve. One of the things that we have noticed when we talk about trades often, we're always talking about the 45-day window. And one of the things that we have noticed is that a lot of the money from a short volatility trade is made within the first 24 days of that 45-day window. So here we have a chart showing the decay of a 16 delta SPY strangle. And what we have found is that from 45 days to 21 days, about 75% of your P&L is made within that time period. This is one of the reasons why we're often saying you either roll or close after 21 days. Because as you get closer and closer to expiration, you never really know what might happen, whether it's news, etc. So oftentimes it's better to operate within that 45-day window and close or roll within 21 days to go to expiration. Finally, volatility is one of the most important things that we talk about on a day-to-day basis and one of the things that we look at quite routinely. There's several different ways of analyzing volatility, but we often are looking at the expected move of any given asset. Every single day we walk in and we look at what's the expected move of the S&P 500 on a day-to-day basis. The easiest way to do that is just to look at the at-the-money straddle, the at-the-money call and put, given where the S&P 500 is trading. Those two prices summed together will give you an idea of any percentage move. And you take that sum and divide it by the current price of the asset, that gives you an idea of what percent move is expected for the S&P 500 on that particular day. You can do the same thing across any duration. You can take the straddle across 30 days and get an idea of what is expected to move across that time period. You could do that for a year out. It really doesn't matter, but understanding what the expected move is gives you an opportunity to understand how you want to trade that asset. Let's just say the expected move for the S&P 500 is 20% over the next 30 days. That's actually fairly high compared to historical norms. And so would you really want to buy that type of move, or would you want to sell it knowing that it's probably not going to do that compared to history, right? That's how we look at markets. The fact is, though, is that 20% might be there for a reason, and understanding that reason is what we try to do often on a day-to-day basis. As I said, there are different ways to look at the expected move. One of the ways that we do it is looking at the market maker move on the tastytrade platform. The plus or minus that you see with the number along with it gives you an idea of the expected move of that given asset. And that's using somewhat of a VIX calculation methodology where it's taking into account the out-of-the-money puts and the out-of-the-money calls as well. So it gives you an idea of the type of volatility it's expecting in that asset over a given amount of time. So that's often what professional traders are doing. We're looking at what the expected move is, how can we take advantage of it, whether we want to buy it or sell it on a day-to-day basis. This chart here shows you the example of an expected move for the S&P 500. When the SPX was 55.65, the cone that you see here on the chart gives you an idea of what the expected move was at that time. In this case, it was looking at a 30-day expected move. A one standard deviation move in this case was about plus or minus 200 points, which in this case was plus or minus 3.59%. So that gives you an idea that the upper bound could have been 57.63 and the lower bound could be 53.65. So how will you take advantage of that move? It just depends on how historically that move compares to where we are now. But knowing how the volatility of an asset is one of the more important things you can do when building a portfolio.
What's up, everyone? My name is Mike Butler, and I'm here to talk to you about statistical intelligence today. You heard a little bit about the show from Jamal previously. We're going to be walking through all of the concepts and strategies that we can deploy in a portfolio, and I'm going to be talking about all of these statistical things that we need to think about when it comes to risk management, position sizing, and all of that good stuff. I started trading in 2012 as a self-taught retail trader right here at DePaul University in Chicago. And I've learned a lot along the way. Hopefully I can give you some of that knowledge today when we're talking about the statistical edge of things when it comes to options trading. Another thing that I think is really important outside of the video content and the live show content that we do all the time is just focusing on that written content. We're pumping out about 100 articles a month on the News and Insights tab on tastylive.com, so definitely check that out if you're looking for more of a written content side of things. You may know me from a beginner series called Mike and His Whiteboard. That was one of the early visual segments that we did on tastylive, and it's all over YouTube as well. So if you're having trouble with some of the concepts, you want more of a visual representation of that, definitely check out that segment. But if you're looking for more real-time talk about the options market, the stock market, futures, what have you, definitely join us on Options Trading Concepts Live every day at 11 a.m. Central. So when it comes to statistical intelligence, I think the biggest thing that relates to options trading is capital efficiency. Whether you're getting that through buying power relief, which just means putting up less capital than the notional risk of the portfolio or the position, or defining the risk and giving yourself the ability to participate in some of these higher priced stocks, these more expensive stocks that can be a little bit harder to afford when it comes to getting leverage in those products. I think when we're talking about options trading and thinking about things and having the fear of products going to zero, yes, that is real. It is a real risk. There are products that go from $100 to $10 and they never see the $100 again. There's other products that go from 100 to 10 and they rally back up. At the end of the day, risk is risk, but when it comes to trading something like the S&P 500 or the NASDAQ, it seems a little impractical to have to put up that notional value of these ETFs, these broad-based indices, going to zero. So there's things that we can do to mitigate that. We can define our risk, especially in accounts like a retirement account where you may be cash secured. You may have to put up that full capital of that product going to zero. We can do things like defining our risk. If I'm selling a put in one of those products, taking a little bullish stance, I can buy a far out of the money put to reduce that capital requirement. So one of the nice things about options trading is just the fact that it gives us that capital efficiency and we can participate in those higher priced stocks in an efficient way, especially in smaller accounts or mid-sized accounts. Risk and profit potential can also easily be manipulated when it comes to structuring different trades. When we're selling premium, especially in an undefined risk way, a lot of times it's you get what you take, and you basically have what you have in the market. You can either take that position or not. When it comes down to defining risk, you have the ability to manipulate strike with spreads. When it comes to debit trades, you can make them wider, you can make them more narrow. You can really control your risk with defined risk trades. And I think that's especially important, again, with those higher priced products that are harder to afford to take undefined risk in or buy 100 shares in. So at the end of the day, when it comes to options trading, we have the ability to take flexible positions and manipulate them. We can take risk where we want it, and we can get protection where we need it in the example of defining our risk, not allowing ourselves to have that same risk of a stock going to zero. Looking at the Tasty Trade platform, we can see an example here with SPY. So when we're looking at SPY, maybe I want to, again, take that bullish position, that neutral to bullish position. I want to sell a put in the S&P 500. I think it's going to stay above my strike, be at or above my strike at expiration, which is what this risk graph shows you here. That's where the max profit would be on a short put strategy. The nice thing about this in a margin account where we have that buying power relief, which really just means that we're able to put up less capital than the notional risk of the position. Here, if I'm selling a put in SPY, in this particular example, this is a slightly in the money put, so it gives you that same feel as a covered call position. We have the ability to put up a fraction of the max risk of the position. When you're looking at the max loss in this trade, we're looking at over $50,000 if the S&P were to go to zero. But if the S&P is going to go that low, I might have other problems to worry about. Given a margin account, we have the ability to put up the capital equivalent to about $10,000 or 1/5 of that position, which can be nice if I wanted to deploy some positions elsewhere. Maybe hedge risk if the market does end up selling off and this position starts to show losses. I can take some of that capital, put on a hedge somewhere else, and maybe that can help me out with this particular position. But at the end of the day, here is an example of being able to take a position, put up less capital than the notional risk of the position, especially when I feel like that risk isn't practical in the case of the S&P is going to zero. Capital allocation is another piece of the puzzle. So we're talking about capital efficiency, giving ourselves the ability to really have potential high return on capital trades and give ourselves the flexibility to define the risk and really manipulate the risk reward on some of these options positions and futures positions for that matter. When it comes to capital allocation though, it's more about thinking about the long term, realizing that I can place a position today and that position can be a winner or loser. But the idea is understanding over time how those probabilities may play out. Whether I'm going to have some quick losers now, some quick winners now. If I'm flipping a coin 100 times, 1,000 times, I know that I'm going to get closer and closer to that expected probability. But for me to flip a coin 1,000 times, I need to make sure that my risk is managed well and my capital allocation is in a place where I'm trading small enough to where I can push that risk through time and get to that higher number of occurrences. When we're talking about diversified portfolios, to kind of add on to that sentence there, we have to think about two things. We need to make sure that, number one, all of our positions aren't to one side of the market. And even if they are, they're not in highly correlated products that will tend to move in the same direction. So a couple of examples here. Let's say I have 3 bullish positions in some high-flying tech stocks in 2024. We've seen NVIDIA go straight to the moon. We've seen AMD kind of follow suit. TSM, similar scenario. All 3 of these products are tech products that are in a similar sector. You would expect them to move in the same direction more often than not. So if I have 3 bullish positions in 3 different products in this case, I'm not really diversified at all. In fact, I would be thinking of that as kind of tripling down with the same idea. If I think NVIDIA, AMD, and TSM are all going to go up and they tend to move in the same direction, I'm basically tripling the risk of that one idea in 3 different products. So that isn't really diversification. That's not really going to hedge my position if the whole tech sector goes down or the whole tech sector goes up. Alternatively, if I have 3 bullish positions in TLT, SPY, the S&P 500, and something like GLD, which is gold, now we're looking at more sector diverse positions. I can have 3 bullish positions in these products, and I don't expect them all to move in the same direction at any point in time. So that's what we're talking about when we're looking at diversity and trying to build diversity within a portfolio. And I know that this can really get overwhelming at times, right? We've already talked about a number of different things that we need to think about with the portfolio, but there's really nothing wrong with starting with what you know or what you focus on. Everyone, not everyone, but most people, I would say, have an iPhone. Maybe you start with Apple. Maybe you really are invested in Apple. You think Apple is going to trade within a 20-point range. Maybe you think it's going to go up. Maybe you think it's going to go down. If you're starting there with that assumption, you can build diversity and you can build out an uncorrelated portfolio from there. So there's really nothing wrong with that, and I would suggest maybe checking that out, especially if you're in a sector. Maybe you work in the auto industry. Maybe you're an engineer. Maybe you work in tech. You have that kind of pulse on the market and you can diversify from there. So I think it's a really good starting point. When it comes to capital allocation though, again, we need to make sure we are keeping some cash on the side. We're not taking a ton of risk at any one point in time because we want to give ourselves the ability to push that risk through time and give ourselves the ability to get to that higher number of occurrences and really get to those expected probabilities. So consider no more than 50% of the account used for options positions at any time. Thinking of that holistically, we can dive a little bit deeper into particular trade size. So we know we need to keep some cash on the side to give ourselves the ability to push through that inevitable volatility that we'll see in the markets. And how are we going to define that? How are we going to look at trade size and keep that trade size small? One thing I always like to come back to is the fact that some people are more opinionated and competitive than others. Just ask my coworker, Nick Batista. He would tell you that I am one of the most stubborn traders in the world, which may or may not be true. At the end of the day, though, regardless of how strong or weak anyone's assumption is, there is one equalizer, and that is trading small. And especially when we're dealing with imperfect information where we don't really know what's going to happen today or tomorrow or in the next 30 minutes or in the next hour, I can have an assumption on what might happen, but I'm not really 100% certain. Trading small is the ultimate equalizer when you have this strong opinion, when you're super competitive, when you don't want to lose. It gives ourselves the ability to take that emotional nature out of the equation and really get down to the statistical numbers and making sure that we have risk management parameters in place before, during, and after the trade is closed. So make sure those trade sizes are small, and ultimately, the smaller the better. When we're looking at positions in terms of being able to absorb volatility, being able to absorb big moves against us, even when we don't see it coming. There's been plenty of times, plenty of examples this year alone where the markets have flown around, whether it's equities, ETFs, it doesn't really matter. There's been huge moves in either direction for all markets. So we need to make sure that we have our trade size small enough to where we can push through that volatility and give ourselves the time frame, the time horizon to get to that large number of occurrences. So consider no more than 5% of the account size per position in terms of capital requirement. So what that really breaks down to is if I have a $100,000 account, no more than $5,000 per position in buying power requirement. And again, the smaller the better. If I have a $100,000 account and I have $1,000 in risk here, $1,000 in risk there, I have the ability to wade through the volatility of the markets much more easily than if I'm taking $25,000 here, $25,000 there in two different positions that can easily move against me. That is what we define as trading too large. So just making sure that we are trading small enough, keeping that risk small, and giving ourselves the ability to push our risk through time is super important. Getting to that high number of occurrences is, again, also very important. So when you are looking at different ways to engage in the market, sometimes we're looking at earnings strategies, right? We want to see what Apple is doing from a quarterly basis. We want to see what NVIDIA has in store for us when it comes to what's next for artificial intelligence or AI. We can embark on these trades, but at the end of the day, we will be engaged in products and positions where we might have a position go way in our favor, and they might have a position where something goes terribly wrong against us. If we're not accounting for that up front, things can get a little hairy. So when we're trading earnings consistently, you can be on the wrong end of a 3 standard deviation move or a 3 times earning expected move. You could also be on the right side of that story. So we need to make sure that when we are trading these things, we're accounting for these scenarios before we place that trade, and that is another important aspect of risk management. Going back to that S&P 500 short put, we have the ability to perpetually roll that position if we are trading small enough. And if I'm in the S&P 500, whether it's through long stock or a high probability trade like a short put, we're still taking risk in that position. If I'm in the S&Ps for 10 years, just look at the history year to year of the S&P 500. Sometimes we're up 10%, sometimes we're up 20%, sometimes we're down 30%, sometimes we're down 40%. So over the long run, if I'm continuously in a market or involved in a marketplace, I'm going to be on both sides of that coin. So trading small and getting to that high number of occurrences where I can expect to get to that high probability is going to be super important. It gets us out of that coin flip where I'm only flipping it 5 times, I don't really have any control over whether I get tails 5 times or heads 5 times. I want to be in a position where I can flip that coin 1,000 times, and now I can much more easily predict that it's going to be pretty close to 50-50. And that's kind of where we want to live when we're taking risk, especially in an imperfect information environment like the stock market. So, short-term expectations are volatile. Long-term expectations are a little bit more predictable. But again, at the end of the day, we need to make sure that our risk is small enough so we can get there. We can generate those large number of occurrences. Trading small allows you to push that risk through time and get there, which really allows us to get back to that high number of occurrences, which gives us a more predictable outcome, especially if we're repeating a high probability strategy over and over and over, like a short put, for example. Another thing that's kind of embedded in all of this is opportunities in extremes, right? If I have a ton of capital on right now and the market drops 20% in the next month, I'm going to be more on the defense. I'm going to be kind of scrambling, trying to figure out how to mitigate this risk, all of this risk that I've taken now because I've maybe traded a little bit too large. If instead I make sure that I'm always thinking of pushing my risk through time and trading small enough to where I can do that, I'm going to have capital on the side that I can utilize for these opportunities and extremes. And really, there's been many extremes in many different markets. You could take a look at gold. We saw a huge move to the upside earlier in 2024. You could look at volatility. Volatility spiked insanely a couple of months ago. You could look at the AI sector. We've seen plenty of stocks go up 100%, 200%. There's plenty of opportunities and extremes, but we need to have the ability and the capital to participate in those products, and that can only be done if we are managing our risk and managing our capital ahead of time as opposed to after the fact. So making sure that we're focusing on trade size and capital allocation will put us in a better position than if we're constantly levered up and we're constantly exposed to the markets all the time. There's not always going to be a situation where we want to be involved in the markets at all points in time at the same degree. When volatility is really low and there aren't really many opportunities, we might not have that same return on capital opportunity. And we might be put in a situation where if all of a sudden volatility rises and opportunities are everywhere, we might be locked up in terms of capital and we don't have the ability to participate in that. So making sure we have cash on the side, and again, no more than 50% in options positions at any time will help us keep that cash on the side, help us push that risk through time and get to these opportunities, which are going to happen every single year. So when we're trying to define this position, we're trying to define what this really means, we can look at the VIX. The VIX is the volatility indicator of the S&P 500. So when the VIX is higher, generally it means that the markets are moving around more volatile. They're going to be more volatile day to day, week to week, month to month, and that can translate to more opportunities in the market. So when the VIX is low, 10 to 15, that's going to be a situation where you're not going to see too many movements up or down. You still can, of course, but the market isn't telling you that we should expect these big moves to happen. On the other side of the coin, when the VIX is at 40 or above, you are more than likely seeing big moves in either direction every single day. So keeping this in mind kind of helps us gauge, where we want to have our capital. Do I want to make sure that I have a lot more capital on the side in a lower volatility environment so I can participate in these higher volatility environments and bigger moves in the market? So looking at this as a consideration, maybe I only have 25% of my portfolio in options positions or positions at all when the VIX is low. Maybe I'm waiting. I'm sitting on the sidelines waiting for a better opportunity. On the other hand, when the VIX is above 40 and I have tons of opportunity in every marketplace, every sector, that's when I'm going to be looking to place new opportunities, looking to place that volatility crush trade, or take a directional stance, because when the VIX is above 40, maybe I have more directional outliers in terms of markets ripping to the downside or upside. Let's wrap it all up with keeping statistics front of mind and all the takeaways that we've talked about today. So again, with options trading, we have the ability to gain leverage where we want it and get protection where we need it. So think of trading in that higher price stock. If I don't have a large account, I can't really go nuts with selling premium or buying premium for that matter, or buying 100 shares of stock. If a product is too expensive, there's things we can do to mitigate our risk, really set our boundaries from a max loss and max profit standpoint, and go from there. Consider no more than 50% of the account used for options positions, and really at the end of the day, that's going to bring us to that point where we are giving ourselves the number of occurrences, we're getting closer to that high number of occurrences if we're not trapped in these situations where the markets are moving, I'm too levered up, I have too many positions on, and now I'm kind of scrambling. We want to make sure that every single day we approach the markets, we have trade size and getting to a higher number of occurrences front of mind. The smaller the better. So when it comes to capital allocation and putting capital to work, no more than 5% of the account in terms of position size when it comes to buying power requirement. So again, if I have a $100,000 account, 5% of that account is $5,000. So if I have less than that, if I'm using $1,000, $2,000, $3,000 per position, whether it's defined risk, undefined risk, we can make that decision as we go. But the smaller we trade, the more volatility we can absorb. And I think that's one of the most important things to consider. Trading small allows us to push that risk through time, which generates a higher number of occurrences, or at least gets us to a position where we can generate those number of occurrences and expected probabilities. Those two kind of go hand in hand. Think again back to that coin flip scenario, right? If I flip it 5 times, I'm going to have a really hard time telling you that 3 of them is going to be heads and 2 of them is going to be tails. If I flip it 1,000 times, it's going to be much closer to 500 and 500 for each of those flips. If we have cash on the side, we're going to be able to participate in those opportunities in extremes, whether you're trading the tech stock sector, whether you're trading gold, bonds, it doesn't really matter. If you have the capital on the side, if you were prepared for a big market move, even if we couldn't see it, you're putting yourself in a better spot to have that statistical intelligence to fight another day, add more positions, take off risk, all these different things that come into the world of options trading, stock trading, and futures trading. And speaking of futures trading, stay tuned because Katie McGarrigle is going to give you an overview of futures trading up next.
Hello everyone, and thank you for watching. Whether you're doing your chores right now, cozied up on the couch, maybe you're driving, so hopefully you're not looking at a screen. My name is Katie McGarrigle, and ideally at this point you have seen what Jamal has spoken about in terms of building a portfolio. You've learned about what Mikey considers as he's building his portfolio. And right now, with me, you're hopefully going to learn how to put all that into practice and continually push the button so that you actually go through the practice of building a full-fledged portfolio. But in a way that is flexible in terms of your risk tolerance, your trading style, the time available that you have to trade, and any other parameters or factors that you need to consider as you are going along your trading journey and navigating those markets. So a bit about me before we jump into the meat of today's discussion. Like I said, my name is Katie McGarrigle. I have been at tastylive since 2012. I actually started as an intern on the production team and came from a broadcast journalism background, so trading and finance was not necessarily my wheelhouse when I first started to learn how to trade. After being on the production team for a little bit of time, I was asked by a couple of the other founders of tastylive if I wanted to learn how to trade options live on air with one of our co-hosts, Tony Batista, and I've been doing it ever since. After a couple of years of learning how to trade options, I then went on to learn how to trade futures and futures options in 2015 with Pete Mulmet, who you will also hear from today. And let me just say, I commend anybody out there that is willing to put in the time and work and mental energy in order to make this a part of your day-to-day life, because there are a lot of things that can intimidate you right out of the gate when you're learning how to do this. So for me, some of those factors that I felt like I have overcome in my time trading have been as follows. 1, the language. Iron condor, jade lizard, implied volatility, all of this felt like a foreign language to me that I just didn't know if I would ever be able to wrap my head around. But I can tell you that over time, it does get a little bit easier and more habitual. Secondly, as I mentioned, I come from a more creative major. And for me, the numbers and the math and the anxiety around if I'm gonna have to be doing mental math was really challenging for me. Additionally, the time involved that goes into building a portfolio. I have a 9-to-5 job at tastylive outside of just doing the show with Mike and Nick on the network. So it was a challenge for me at first to wonder or be freaked out by whether or not I would have to be sitting by my platform looking at every single position and every single tick every second of the day. Last but not least, I think all of us can relate to this. Oftentimes when you turn on traditional financial media, it feels as though everybody there knows something that you just don't know. And I had a lot of imposter syndrome when I first started to learn how to do this. I felt like, how was there any way that a girl from the south side of Chicago could ever kind of overcome and get even over just like my own internal insecurities and fears? But here I am today, talking to all of you fine people. Last but not least, one personal thing about me that I hope comes in handy for you as you are reading and watching and following along today is that I am a list maker. It doesn't matter if it's a daily task list, yearly goals, gifts for people that I want to get them for Christmas. I have a list for just about everything. So just you wait, you might see a couple things that you can utilize and add to your toolbox to help you gut check yourself as you are building a portfolio. So, as we talked about, Jamal has explained why it's important to diversify, what to consider in terms of capital allocation. Mikey discussed how to get an edge, how to boost your number of occurrences, why implied volatility matters when you're looking to build a portfolio. And now, maybe you have a couple of tried and true bread and butter positions in your account, but how can you actually take that and expand so that you have a diverse portfolio with all different types of asset classes, all different types of trading products? What do you do and where do you look for those opportunities? Well, as you can see, this was just 2 or so hours in one single set of traditional financial media. I found all of these headlines that give you opportunities, extremes, what other people are talking about, what other people are thinking about. And for most people, this is just kind of white noise that they may glaze over as they're doing their regular work or as they're going about their day. But as traders, we can tap into this information and help us take the next steps towards building a trade and putting it into your overall account. Before I go too far ahead though, let's look at a couple more of these headlines in depth. Currency markets are in a deep freeze. Gold hits new fresh records. Crypto trading volume is at all-time highs. What if you aren't a corn farmer? Or what if you don't understand the price dynamics of copper and what is going to push and pull that particular market? Is there still room for that in your account? I would argue that yes, there is. Does product expertise matter? Does it matter that I'm not a copper miner? Does it matter that I'm not a corn farmer? I would argue that product indifference is one of the most powerful tools that we constantly need to remind ourselves of, especially as individual retail traders. Why do I argue that? Well, product indifference is even more important in lower volatility or one-sided equity markets. Additionally, it may reduce the volatility of your returns if you're overexposed to one asset class or one set of equities or one sector too greatly. Additionally, it contributes to our number of occurrences, which, as we know from Mikey's presentation, number of occurrences allows the probabilities in our portfolio to fully play out. Furthermore, product indifference allows us to have fewer roadblocks in our portfolio, meaning that maybe if copper isn't looking like an opportune example for you to put into your portfolio today, you can pivot to one of those other headlines or one of those price extremes or whatever other indicators the market is giving you. But with that, you might also be like, Katie, what about things that feel too large notionally for me to actually participate in as a trader? I don't have a Sosnoff-sized account where I can trade and buy and sell E-mini S&P futures that are worth $250,000 in notional. Well, I would actually argue that leverage, particularly in the world of derivatives like options and like futures and futures options, should not necessarily equal fear. They can actually help potentially enhance our return on capital for our portfolios. Last but not least, one of the things that one of my trading mentors taught me when I was learning how to navigate new products or enter new types of asset classes was this phrase: traders are like sharks. If you're not moving forward, you're dead. And while that may seem a little bit extreme to most people out there, I think it just kind of goes to show that knowledge is power, and continually learning and developing and discovering new products and new ways to trade those products and new ways to size up and down those products or new ways to manage those products, that ultimately allows us to stay in this trading game a little bit longer and ideally improve our probability of success as we're doing so. So, with all of that said, you might remember in Jamal's presentation, he had this beautiful set of boxes that he showed in terms of how to put your capital to work in each of the trading vehicles that we talk about day in and day out on tastylive. Stocks, options, futures, futures options. But once you've kind of chosen maybe the product or the asset class that you're interested in, how do you ultimately go forward to that next step and choose which of those vehicles in which to participate with? Well, like I said early on, I do have a list for you, or rather a handful of lists for you, that hopefully you can use as you consider which of these things is going to fit best in your portfolio for you right at this very moment. So, for example, maybe you already have on a ton of equity investments that are long-term plays and you need to boost your exposure or your number of occurrences with futures or with options. In the example of potentially utilizing options, you may say, oh, I actually need a little bit more dynamic delta for my portfolio rather than the static delta that stock affords me. Or maybe on the futures side, you might say, man, I'm really busy at work these next couple of weeks, and so looking at my platform during normal market hours is gonna be a little tough. Maybe futures, because they offered that 23-hour tradable access, might be a better vehicle for you at the moment. No matter what you end up with, you ultimately need to consider what is at the bottom of this list in neon green. That is, which products are the most liquid? How does your risk tolerance play into that? Does your account size contribute to what you can utilize in terms of each position's buying power? How much time do you have available to enter, manage, and exit these trades? And of course, considerations for tax treatment. All right, so going back to Jamal's example, maybe we've decided, like we said, that we need to end up with a couple of more options trades in our portfolio. One such way we can start to utilize that, particularly in a product that has been very popular in terms of traditional financial media, as well as discussion this year, is gold. Gold is trading near its highs. It's been in and out of the news. It's had pretty large swings in price over the last 12 months. And in addition to that, it's also a relatively liquid product to trade across several different types of trading vehicles, which you'll see in the next few slides. So rather than maybe taking a directional position on gold over the next 30 to 60 days, maybe I want to do something that's a little bit more neutral. One such way I can start to do that checks the box of options trades, checks the box of neutrality, and checks the box of defined risk is with a gold iron condor in the ETF GLD. So here, this is something that I, in my account of about $25,000 to $50,000, might consider as part of one of my standard trades to build on my portfolio. For me, my risk tolerance tends to be around $1,000 in spread width. And as you can see by the iron condor that I've built, the most I can make on this trade is around $300. The most I can lose is around $700. Add that up, and you've got that $1,000 in risk that is comfortable for me given my risk tolerance, the time I have to trade, and all the other factors that we've considered in a couple of the lists that I've already shown you. On the flip side of that, maybe my options portfolio looks pretty good and I need a couple more static plays with static delta, and I also want to get a little bit more access to something that trades a little bit more around the clock. Maybe that's when I start to look instead at futures or futures options. So here, rather than that defined risk iron condor, I've actually shown you a couple of other ways that you might be able to get directional and then determine whether you want to be defined risk, wherein you know what you can make and lose on entry for the trade, or if you want a little bit more of a risk one to make one, 50-50 probability of success. If you look at the top of the table that I have in this slide, you'll see that I have the gold major futures contract. And it's no small bite. It's very difficult for somebody that is maybe in a newer account or maybe doesn't have a lot of capital to put to work to tie up all their buying power in one of these major futures contracts that can be worth over $200,000 in notional exposure and $11,000 or so in buying power right out of the gate. How do you combat that? How do you stay flexible in order to find a way for this to still fit your portfolio building? Enter the next two rows on this table, right? You can look at micro gold, which comes in at 1/10 of the size of the major /GC contract, and therefore only takes 1/10 of the buying power. And as I've already said, my risk tolerance tends to be around that $1,000 in buying power per position, so the micro gold futures contracts tend to work out very well in a portfolio such as mine. Maybe though, I'm not quite ready for the 50-50 probability of success that a long or short futures contract gives you, and I still want to actually get a little directional exposure, but in a way where maybe my probability of success is closer to 65 to 70%. That probability of success being the likelihood that I'll make at least 1 penny on this trade. Well, I can look at the gold futures options, which are also relatively liquid to participate in. They have the 23-hour tradable access that might be good for somebody who's a bit short on time during the regular working day. And they, again, check that box of the $1,000 in spread width. I'm potentially going to be able to profit around $300 in this trade, while the most I can lose on this trade is $700, and I have a 70 to 65% probability of success for this position. So I realize that I just threw a bunch of different options at you, no pun intended, in terms of how you can start to build, particularly gold, into your portfolio as you are looking to kind of just continue to be flexible and continue to find things that ultimately check all of the boxes that the rest of our presenters are discussing today. You can see that there's a lot going on and a lot to consider in terms of the buying power that you're going to be putting up for these positions, the notional exposure that you're going to have when you're buying and selling or doing a combination of any of these positions, as well as the management techniques that might be afforded to you if you are looking to get these trades in your account and, through the duration of the trade for whatever time frame suits you best. But maybe you already have gold on and you have a really strong opinion there, but you want a little bit more metals exposure. This is the power of being flexible, and this is what I mean by being flexible. You can also pivot entirely to somewhere else in the metal space that might have a very unique relationship with gold. So you can look at products like silver or copper and how they correlate to one another, and then kind of go through the same exercise that we just did with gold, but for these other trading vehicles or other products that are in the metals asset class. All right, hopefully by now I have convinced you that being flexible and finding ways to pivot your positions or your risk tolerance or your trades is ultimately going to benefit you as you continue in your trading journey and as you navigate the markets. But what other things can we consider or should we consider in order for us to feel comfortable as soon as this trade is filled and as we navigate the position in case it doesn't necessarily work out for us right away, or if it does and we need to exit the position. Well, something that we always talk about day in and day out on Tasty Live is controlling your knowns. There is so much more power in kind of running through the various scenarios that you have as you're looking to get filled on a trade. And it reduces your anxiety and emotion in the moment if those things don't work out the moment that you're filled on the trade. If you see an outsized move in the market, if a binary event continues to push and pull markets in all sorts of directions, controlling your knowns on entry is going to tamper down a little bit of that anxiety and chaos that comes up day to day as we trade. So, what do I mean by those knowns? First off, size. Size is everything. Start small. Especially if it's a newer product for you, I would reduce your trade size by utilizing smaller products, defining your risk, or maybe if you are a 5 to 10 contract trader normally, maybe with something new, you kind of dial that back a little bit and start with only 1 or 2 contracts that you're trading. Secondly, price needs to be of the utmost consideration. Stick to liquid products and don't chase your entry price. I know sometimes we can all get caught up in the moment of just wanting to push the button and get filled on a trade and try something new and see how it kind of ebbs and flows in your portfolio. But it's really important that you are able to control that entry trade price in order to reduce slippage and improve your probability of success from entry. Thirdly, consider your strategy quite a bit before you start to kind of go down this path. Do you need static or dynamic deltas? Are you leveraging comfortably? The last 2 that I want to touch on are targets and tactics. So considering what you can make on this trade, what you can lose on this trade comfortably that will enable you to stay trading for the long haul. A lot of us hopefully are hoping to do this for a very long time, and it would be a bummer if we got blown out too quickly or if we had one bad trade completely wipe out the other profits that we might be seeing in our portfolio. Additionally, those tactics. If we are getting tested on a trade through any part of the duration of the trade, what are the things that we can consider to kind of soften or hedge that loss? Is it rolling out in time? Is it reducing the number of contracts? Is it adding some type of other hedging tool in order to make this trade more suitable for us? Knowing and considering all those tactics before you're even filled on the position is ultimately going to help you for the long haul. On top of that, there are some things that the technology can actually do for you that will help you learn, especially about new products that you may have in your account as you go. 2 of those things that are on the Tasty Trade platform that I like to have on my portfolio tab at any given time are 1, beta weighted delta, which basically helps you understand your positions in relation to any type of move in traditional markets. And secondly to that, particularly for those of you that are new to futures or futures options, this second edition is really helpful. It is ETF delta equivalent. So that basically shows you your futures delta equivalent to its respective ETF. So in the example that I have on the slide, you'll see that I have on some crude oil and gold futures options in my account. And if I were to look at crude particularly, that ETF equivalent delta is basically showing me my directional exposure in terms of USO, crude oil's corresponding ETF. And that's basically it. I'm just kidding. I know that was a lot. I know that it can be very intimidating to kind of see all of this in action and think about all of the things you need to consider in real time, and also managing, your day-to-day life and wanting to make this a successful, hobby or endeavor for you. But that's why I have yet again given you a couple more lists in order to make you a more mechanical, ideally make you more successful, and enable you to be a little bit more confident as you are becoming more flexible with how you approach your portfolio and the products that are within that. So First and foremost, the search. What are the asset classes that I should be thinking about? Are there any significant earnings announcements coming up, economic events, any geopolitical news that I need to be mindful of that might push and pull or help me identify some of those extremes that we talked about earlier today? Then, once you've chosen and you've figured out and narrowed down your search, what does the entry look like for you? The time frame, the liquidity, your maximum profit and loss, the capital required to put on these trades. Is this an engagement trade or is this more of a core position for you? Once you've kind of checked off those two sets of lists and you get filled on the trade, what does the management look like for that? Nick Batista is going to do a great presentation talking all about what he thinks about and considers as he's managing his portfolio. But what is your profit target? How do you roll up and down if your position is tested? Should you be cutting size on something new to you? Can you add a correlated product to offset losses that you might be seeing somewhere else? And then last but not least, that 30,000-foot view that both Pete and Tom are talking about in their presentations, but getting your product mix in check. Making sure that you have uncorrelated occurrences to one another, that your strategies are all diverse, that you have a, maybe a directional portfolio or a neutral portfolio depending on your preferences. All of those things, even though they seem very monotonous, it is a great way to kind of build a muscle memory of building new positions, building a portfolio, and ideally successfully managing one as well. So what does being flexible in a portfolio ultimately mean? What are the big takeaways that I hope you get out of this as you go on to the next sets of presentations? One, product indifference can lessen overall portfolio correlation, and it can knock down swings in your overall profit and loss of your portfolio. Two, there is a sector, trading vehicle, strategy for every account size and experience level. Three, by controlling our knowns on trade entry, even those new to you products can fit into a portfolio without drastically skewing your exposure to one asset class or sector or whatever else is on your mind as you're doing this. Four, utilize the trading technology available to you. Gone are the days of having to do a ton of mental math and a ton of different calculations. There are so many new metrics and customizations you can make within your trading platforms that enable you to feel more confident in the decisions that you're making day in and day out. And last but not least, when you're doubting your mechanics, make a list. Thank you all for your time. I'm Katie McGarrigle. That's it.
I'm Nick Batista, and this is what I'm trading. I started trading with tastylive in 2014, live on the show. I currently host a couple different shows, from Johnny Trades, a trade idea segment for smaller sized accounts, as well as Options Trading Concepts Live every day at 11 a.m. Central Time with my friend Mike Butler. I really like to get into the weeds of things. All the weird stuff that happens in the markets, from gamma squeezes to pops in volatility, from inverse ETFs. Anything you've got questions on in those regards are my favorite topics. But today we are going to talk about options trading, and specifically the things that we can control in options trading. We're going to talk about trading options, and we're going to talk about duration and time, our theta decay. We're going to talk about volatility, our Vega. We're going to talk about direction and size, our delta exposure. We're going to talk about why we manage winners. We're going to talk about managing and rolling positions, and we're going to talk about how important number of occurrences is to our long-term success. The first thing that we can control on entry with options trading is our time. Our time decay is theta. Theta is one of the few constants we can trade around. It's the passage of time. It represents the value decay over a one-day passage of time for that option position. Time allows us non-binary outcomes with options. As time passes, value decays even with movements in the stock or futures. The outcome is not up or down, it can be sideways. Time always has value. which allows for a continuation of both profitable and losing positions. Rolling out in time allows us to capture more of that premium as we continue to trade that position. When we talk about duration and theta decay, it's important to understand that theta decay is not linear. One passage of time is not worth $1 along the curve for an options price. Volatility and time go hand in hand. So when we look at time value, as we go further out on the curve, of course there's going to be more value to that option, but that value decay is going to be much slower relative to closer to expiration options. When you hear us on the show, we'll constantly talk about the 45-day entry point. Around that 40 to 50-day mark is when time decay starts to ramp up. This time decay becomes more consistent as we get through the duration of the trade to the point of the 21-day mark, another constant you'll hear us talking about on the show. After that point, the decay of that option becomes much more volatile. That's because changes in the price become much more substantial to the option. The time value of the option becomes much lesser. There's only a certain amount of time left until expiration, as well as just changes in the market as a whole. So when we talk about time decay, it's not always trying to capture the most time. It's trying to capture the most optimal time to be in a position. When we talk about volatility, Vega, volatility is the expected move in the underlying or the market as a whole. One of the things that we can quantify, or at least trade around on entry, is whether this value is high or low. Is there a lot of fear in the market right now? Is there not a lot of fear in the market? Is there a trade there? So we know that volatility is a mean reverting metric. Volatility tends to stay at highs for short periods of time. It goes to lows and stays at lows for short periods of time. And it tends to cluster around a mean. What that means is that volatility gives us an opportunity. When volatility is high, it tends to come down. When volatility is low, it tends to expand. And it stays in a constant middle area. Volatility at its core, though, represents opportunity via uncertainty. If everybody knew the outcome of whether the stock's going to go up or down, there would be no volatility. We'd all know the outcome. Volatility represents the uncertainty of what may happen into the future and is a tradable asset for us as options traders. The easiest way to understand volatility is to take out the stock itself. We're not going to mention what stock this is, but if I told you that the relative distance that you can sell premium on this underlying in these two images for the same amount of value, you'd want to be further away from the stock's current price. This is volatility. When we look at a 30% implied volatility, it means that on a yearly basis, the stock's expected movement is supposed to be 30% up or down. It's priced to be 30% up or down. When a stock has an 80% implied volatility, the expectation in the market is that the stock can move 80% up or 80% down. When we're looking for a premium, and high premium relative to implied volatility relative to time, higher implied volatility underlyings afford us that further out of the money position as well as higher option value. So when we think about volatility, all else being equal, we'd always want to sell premium and be short premium in higher volatility underlyings. When we talk about delta, which is our directional exposure, it's a non-binary outcome as well. Delta is not purely directional. One of the things with non-option traders is that their outcomes are binary. If they're long the stock and the stock goes up, it's a good thing. If they're long the stock and the stock goes down, it's a bad thing. It's a 50-50 shot on a day-to-day basis, and we've all experienced that. With options, that's not the case. It's a non-binary outcome and is not purely directional. Options allow for a directional assumption that provides the potential to get long and short dynamically. When we're selling puts or selling calls or selling strangles or selling iron condors, it allows us to be directional or non-directional at certain points. If you sell a 30 delta put, You're long that stock and you'd like that stock to go up, but you don't need that stock to go up right now. It can go up in a week or maybe go down a little bit or float around sideways. Options allow us to be directional while also participating in non-directional movements. Delta also has exposure to time and volatility. And time and volatility are natural hedges to our directional exposure, like we have with stocks or futures. If you're long a stock or you're long a futures contract and you sell a call against that position, you're hedging some of the directional exposure. You still want that position to go higher, but selling that call allows you to hedge some of that downside. So why do we roll positions? It comes down to those three things that we talked about just now: Theta, Vega, and Delta. When we talk about Theta, rolling out in time gives us more time to be right. It extends the duration on that position. When we talk about volatility, rolling out in time allows us to reduce some of that volatility, especially with shorter dated options. Rolling out in time allows us to reduce our outlier risk. Of course, our delta exposure will reduce as we roll those positions further out in time. And all of this is done without adding more risk to the position, rolling forward our losses to give us more time to be right, to get more exposure to volatility, to get less delta exposure and be less directional, and rolling into new high probability trades. The common misconception with closing positions is the old adage that you should let your winners run. For us, we close positions early, and we do this for a number of reasons. The first reason, and it goes back to our Theta, Vega, Delta discussions, you're on the optimal point in the decay curve. You have diminishing margins of return. When you sell premium and you have a capped profit potential, you can only make so much. At a certain point, that value becomes lesser and lesser and lesser and is all risk. You have diminishing margins of return. If you sell something for $1 and it's now trading at 50 cents, you can only make 50 more cents. If you sell something for $1 and it's now trading at 10 cents, you can only make 10 more cents. You still have all the same risk on. By closing out of positions, you allow yourself the ability to capture that profit potential as well as reduce your overall risk. Of course, every time you leave a position on, when you let those winners run, you have all your profit on the table as well as all of the original risk. Of course, one of the reasons we'll close a position is because of changes in volatility. As we discussed, volatility goes to high points and low points and only stays at those points for a small period of time. Most of the time, volatility clusters around a mean. So if you sell something at the height of volatility, when people are scared, when panic is on the streets, when the blood is in the streets, you are getting paid the highest amount. If that volatility comes in and goes towards a mean, that's one of the things that you've been able to control on entry. You've captured that volatility premium. We think about closing a position if our directional assumption has played out. Of course, if you sell a put and the stock goes up, you were right on that trade. It's time to close that position and get into a new position. And finally, we would close a position for capital efficiency. Can I deploy that capital more efficiently in another position? Number of occurrences is another hugely important point of options trading. How important is this? Well, increasing the number of occurrences will allow for more predictable outcomes in trading. If you flip a coin 10 times, it's not a given that you'll hit a 50-50 probability. As you add more occurrences and more coin flips, the probabilities tend to play out. And that same concept applies to option trading. If you trade one time, you may not hit your 70 or 80% probability of success. But over a long period of time and a number of occurrences, those probabilities tend to play out. So increasing the number of occurrences will allow for a more predictable outcome with our options trading. And so taking positions and closing positions out allows us to redeploy and keep our capital optimized. It gives us that high exposure to Theta and Vega and becoming less directional, but also allows us to let the probabilities play out and to hit those numbers of occurrences. To put it all together, options provide dynamic exposure to our portfolio. They take advantage of extremes in price and volatility. They allow us time to be right. Time is both a benefit to our assumption as well as a passive value decay. Delta is a dynamic position for our portfolio. It allows us to buy into weakness, sell into strength dynamically as the market moves. And finally, number of occurrences. For us to hit those probabilities of success, we need to be able to close positions, roll them further out in time, and keep our capital efficiency as high as possible.
Hi guys, my name is Pete Molmat. I'm CEO of tastyFX, and I've been a futures trader for over 42 years. Today we're talking about starting an active trader journey. How do I become an active trader? What does that mean? It sounds overwhelming. How do I actively manage my portfolio? We're going to break it down for you in really simple steps. And this is a journey, not a race. You know, Jamal, Katie, Mike, and Nick have given us great foundation with strategies, products, and tools to use. Now I'm going to put them to work a little bit for us and show you in a very simple fashion how you can start to engage with markets with capitally efficient products and start that active trader journey. We're going to look at a $100,000 portfolio. Very traditional, 30% long stock, 25% short volatility, 10% long gold, 10% long bonds, our safe haven flows, and 25% cash that we can use to take advantage of opportunities. So, you know, the one thing we've all talked about, and you see on Tasty Trade every day, is that markets move, prices move, and with that, our opinions move. How do we engage with product? How do we take this core portfolio and start to take an active trader journey? Now, I want to say that everyone's journey is unique and onto themselves. It's not a race. We're not looking to add lots of product and lots of complexity right away. It's a measured steps of engagement around product. And how do we do that? Today, I'm going to walk you through how you use futures to do that, how you use futures to start to manage parts of your portfolio and take advantage of opportunities. Because we know that prices change, markets change, and your opinions change. And when those opinions change, how can you take advantage of the movement and opportunity? So let's start at the very core part of our portfolio, the stock portion. So in our synthetic portfolio, we're long $30,000 in stock. Now, it may be across a number of different names, it may be in only a few, but how do we take advantage of when markets move? Now, in this example we're looking at, we're going to talk about using S&P E-mini micro futures. Now, S&P futures have been around for about 20 years. Micro futures have been around for about 10. And what micro futures let us do is get all the benefits of futures trading. 23-hour-a-day access, 5 days a week, liquid markets. And really, we're looking at the granddaddy of benchmarks. In the world of equity benchmarks, the S&P 500 is the big boy. At over $7 trillion of funds benchmarked to it, it is the granddaddy, it's the big boy. So it's the one we want to take a look at. So let's look at MES, the micro E-mini S&P future, which gives us exposure into the S&P 500 contract. So if we have a portfolio that's got a strong positive correlation to S&Ps, which most of us do in some form or another, we can look at using MES, micro E-mini S&P futures, to hedge that portfolio. Now, we're not looking to disassemble our portfolio. We want to keep our portfolio intact, but what we want to use is a set of capitally efficient products that will let us neutralize exposure to take advantage of price extremes. Now, in our first example here, we have about $30,000 of notional exposure in our core portfolio. One micro ES contract, the notional value on it is about $26,000 of exposure, either long or short. Now, the buying power required on that is $1,600. One of the great advantages of futures, leverage, or the way we look at it, capital efficiency. We're all constrained by the amount of capital we have. How do we use it effectively? Futures give you that capitally efficient tool to be able to hedge, manage, and take advantage of movement in the markets. So let's take a look at this movement that we've highlighted here. You know, beginning of the year, we saw the equity index markets rally by almost 20%. Now, some may think that was a little bit too far, too fast. what do we do about that? We've got an equity portfolio that's had a great run. Do we disassemble it? Do we sell our NVIDIA? Do we sell our Amazon? Do we sell our Ford, our Tesla? Or do we use a micro ES contract to neutralize that exposure? We go ahead and let's walk through the mechanics of how this actually works. So we've got our core portfolio of $30,000. We sell the one micro ES future. That leaves us with net long of approximately $4,000 in our portfolio, but we've neutralized the majority of that exposure. So if the market does turn, comes back down, in this example, we sold at 5,300, we bought back at 5,000, and we made $1,500 on that scalp. We buy the future back in, we now have our core long exposure of $30,000 in stock. What we've done is take advantage of market extremes and never have to disassemble our core portfolio. How active do you do this? How often do you do this? This is where the journey is up to you. And again, it's an incremental journey. We take steps at a time. So we've talked about the core position here in equity indexes and using equity index futures to hedge that core position. Let's take a look at the other side of the coin, because while we've neutralized our exposure in that one position and been able to make $1,500 in profit, and guys, I want you to think about this, not in terms of stacking up a second bucket to fill with money on top of your first, but this is really looking at it from a cost basis reduction standpoint. What I'm doing with these scalps, and again, this is what we're doing. Tom and Tony do it every day on the show. We're scalping around our position. We're scalping around our idea. How often we do that is really up to us and our bandwidth and our ability to engage with markets. But one of the key things to do is think about every time we do this, we are looking for a profit, but we may be exposed to a loss. So strategies need rules. They need rules for both profit and loss. So it's so important. You know, it's funny, I've been asked after trading 40 years, hey, what stands out about your big winning days? And honestly, we've all had them in our careers as floor traders and off-floor traders. But what stands out are the losing days where I lost mechanics and I wasn't disciplined and markets got away from me. So one of the things I always look at when I start to look at trading opportunities and scalping opportunities, even around a core position, is where am I going to get out of this position when I'm right? But more importantly, where am I going to get out when I'm wrong? In other words, where am I going to neutralize that scalp? Because remember, what we're doing here is we're not leaning short. What we've done is neutralize our long exposure. We still have our core portfolio, but we don't want to necessarily neutralize that forever. So if the market continues to rally, as in this example here, we want to look at some sort of rules-based approach, whether it be around standard deviations or loss and profit metric that's comfortable to you, and everybody's loss and comfort metric is different, that does not take your head out of the game. Loss is so big that you're uncomfortable and can't manage. We want to make those decisions ahead of time. That way we can stay mechanical, symmetrical, and most importantly, stay small. So if we do that, we put ourselves in a good position. Trust me, in 42 years, still don't like having losing days, but it's the tone and the mindset you come back with the next day, which is so important. You've got to be able to have those losses not start to cloud your judgment, not start to prevent you from taking advantage of opportunity. I've seen guys who've sold into a rising market and we've seen a market pull back, and I've said, guys I used to stand with in the pit, why don't you try it from the long side? No, I've invested so much from the short side, I can't possibly get long. Now, if you think about that, where those losses have really destroyed their ability to look at a market independently, you've almost guaranteed yourself a losing situation. They've taken out the one side of the market, which is being long in an uptrending market, and said, I can only sell because I've, quote unquote, invested so much being short and been wrong. This is why management is so important. Make those decisions early and stick to them, and come back to the game the next day with a fresh set of eyes and an unbiased opinion. And that way, you can stay engaged and take advantage of opportunities when they present themselves. The management and the mechanics are so critical. Time frames. When do you want to manage? This is part of our unique active trader journey that's different for every single one of us. Now, you look at Tom, Tony, we trade pretty much from the minute the market's open to the minute they close, Sunday at 5 to Friday at 4. And we're fortunate enough to be able to engage with products all day long. Most of us can't do that. So how do we start this journey? Maybe it's on a quarterly basis. I look at my portfolio and look where I can manage, where I can take advantage of. Maybe it's on a weekly basis where you do something called swing trading. Maybe it's on an intraday basis like we are, where you're in back and forth around a core position. It's not a race to get to be the most active trader. One of the most disciplined things you can do, and one of the hardest things it was for floor traders who came off the floor and went in front of the screen, was to sit there and do nothing. It felt like you weren't doing your job. Sometimes that's the best decision. That's the disciplined decision. So stick to those mechanics. Stick within time frames when you can engage with product, where you can manage product, and you can stay disciplined. It's not a race to get to scalping every day. It's a situation, a time frame that fits for you on your journey. And your journey is unique. So let's move down our portfolio a little bit and talk about another part of our asset classes. We talked about gold and bonds, our safe haven plays. What do we do with those? Well, here's a classic example. I don't know who hasn't traded stocks this year, who doesn't have an opinion about the gold market. I mean, the gold market has rallied almost 30% from the mid-1700s to printing over close to $2,700 a couple of weeks ago. So we've seen a tremendous rally in gold. Now, some think the next stop is 3,000. Other thinks that this is going to be a classic gold rally. We're going to punch, 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 and then it's going to capitulate. We don't know. I do know that this kind of movement is outsized by any extreme to move $500 or 20% in the matter of 3 or 4 months. So if I had that long core gold exposure, whether it be physical gold or coins or whatever you have, if you have that flight to quality hedge within your portfolio and you want to neutralize it, a micro gold contract, MGC, is the perfect thing to do. 10 ounces of gold gives you that exposure. Simple way, $25,000 in exposure, a simple way to take advantage of a price extreme, manage that exposure. And again, we don't want to overhedge. We want to hedge appropriately our core position. What we've done here by selling the micro gold is we've neutralized our core long position without going to sell our physical gold or whatever we have as a safe haven hedge. We want to keep that part engaged throughout this entire active trader journey exercise to manage our portfolio. We never touch the portfolio. We use capitally efficient products to take advantage of price extremes, and when our opinion changes, to engage with product. So this is a great example of using a product that will give you that neutralization at a very effective capital efficient level and trade size. So let's take a look at the next iteration of your journey. And that may be something, it goes by a number of different names: pairs trading, relative value trading, basis arbitrage. All this is really the same thing, and it's looking at the relative value of two assets and trading one against the other. Now, it's as simple as this. We've got our core position, and I've got 3 different markets up here. Gold, which we know has been on a tear. FXI, the Chinese stock index, which has not participated in this at all. And the Aussie dollar, which has just recently gotten to unchanged on the year. So we know gold and Aussie have a very strong positive correlation. And gold and Aussie and FXI also have a strong positive correlation at 0.5. They tend to move together. So when we look at a relative value or a pairs trade, we like to find products that tend to move together but have diverged in price. Now here's an example. We sold our gold future to neutralize our core gold exposure. Why don't we add something back in that's correlated but undervalued, like FXI, like the Australian dollar, something that on a relative basis can revert. What are we doing? We're creating an independent occurrence. We're creating a trade that is at a price extreme, and we are at the same time never disassembling our core exposure. So this is really what a pairs trade is. It's a simple iteration on managing and looking for value within our core portfolio. So buying some FXI while keeping the short gold future short, We haven't touched our core position, but we've now added another type of occurrence to that active trader journey of finding value within markets. You know, one of the things we talk about, and I always ask is, well, what kind of exposure do you have? Well, I got a lot of tech. I've got a lot of consumer staples. I think the market's going to roll over. I've got a pretty balanced portfolio. Do you know what in the US, do you know what we all have? We have a lot of dollar exposure. And if you think about it, everything we trade is priced in dollars. Every product we trade, whether it be a stock, a future, anything is priced in dollars. So a great way to look at that next level of diversification or hedging your portfolio is looking at a currency trade. Now, yen has been recently multi-decade lows. The yen has been incredibly beat up in the marketplace. Part of it, interest rate differentials, but we've seen lows we haven't seen in, I think, almost 30 years. Now, adding a yen long to your position neutralizes some of your core long dollar position, because when we buy a currency, we pay for it in dollars. So by adding yen, this is another step in diversifying our core portfolio without ever, and hedging it without ever touching it. So the idea of adding this currency component when they're at an extreme like this is a really interesting addition to how do I actively engage? How do I start to trade every day around my core portfolio? And this dollar piece is a really interesting aspect. You know, in the US, we are very US-centric, and FX is such a part of everyone's life outside of the US pretty much, and the awareness of it. For us, it's really a way to add another uncorrelated component to our core portfolio that hedges exposure and gives us the opportunity to take advantage of market extremes like this. Can we also look at using options on futures? Absolutely. A great way to do this is by selling premium in options on futures. The currencies have great liquid deep options markets that you can trade. Very capitally efficient, very simple way to gain exposure. So whether it be through options or through the underlying futures markets, both give you the opportunity to hedge and look for opportunity around product. So one last thing I want to talk about. Always check your size before you start hedging. And that's what we're doing here. We're hedging our core portfolio. We're taking pieces on, we're leaving pieces on, and by hedging, we're neutralizing exposure without disassembling it. So always be mindful that you're neutralizing, not over-hedging. So look at the notional of the product. What is the size of the product? Does it fit against my core exposure? It's very important to do. The last thing you want to do is be right the market, in the example of stocks, be long stock, your core portfolio is long stocks, but you're short twice as many equity index futures against it, which means you've not neutralized your position, but you've actually turned it around. And that's not necessarily the exercise we're starting with in our active trader journey. We're looking to take advantage of market movement and opportunities that present themselves, hedge them, and do that. So always be mindful. There's nothing worse than being right the market, that my core portfolio is right, but I'm losing money because I've overhedged. Calculate the exposures, be mindful of them, and remember, management of those trade ideas is less important than your core positions. And make sure those positions, those hedges, are of the appropriate size so you are not, in effect, disassembling and turning around your portfolio, but you're just neutralizing parts of it. So today we've started your active trader journey, and that journey is up to you. It could be one trade a month, one trade a quarter, or it could be trading every single day. It's not a race, guys. It's a journey, and it's one that you have to take and take it in incremental steps and make sure that you're aware that the product fits, the size fits, and that you are, whether you're using risk-based mechanics around a one standard deviation, get in and get out level, or you're using another rules-based approach, keep that loss and gain component of the hedge symmetrical. And make sure those losses are comfortable so you can come back the next day with a clear set of eyes. You do this, you start this process. Again, this is a great way to start to engage with markets, with products, and get more involved in taking that ownership of that portfolio and starting your active trader journey.
Hello, everybody. My name is Tom Sosnoff, and it's my job here today to tie everything together from the other 5 speakers. And I'm going to try to do that by building a portfolio with you. First, let's just give you a little bio for some of you might be new to Tasty and might be new to Tom. So a little bit of my bio. I spent 20 years as a market maker on the floor of the SIBO. In 1999-2000, we built a company called Thinkorswim. We sold it to TD Ameritrade in 2009. In 2011, we founded tastytrade. At that point, it was a network. Now it's a brokerage firm, and tastylive is the network. We have been doing this now for about 13 years. We're going on year number 14, and this is our 3rd digital collectible. It's super exciting to us. I hope you enjoy it. I hope you get a lot out of it. I think there's been an amazing number of takeaways, and now I'm going to try to tie everything together for you. For starters, though, I want to give you some of the takeaways from the last 5 speakers. And the first thing is, and this is the challenge to everybody at Tasty, and this is the challenge really in all of finance. It is, how do we make all these complex financial topics simple to understand and simple to execute? How do we make everything practical? And to do that, what I'm going to do is I'm going to apply the takeaways, or try to apply the takeaways that from the other 5 speakers, and then bring it all together in a portfolio, kind of building out a portfolio at the end. So the first thing is, and I think we've talked about this at length today, which is essentially building a portfolio with a bunch of different products that are non-correlated, and essentially where you as the user, you as the trader, you're agnostic to product. Meaning that it doesn't matter what you trade. It makes no difference if it's a future, if it's a futures option, if it's a stock, if it's a stock option, if it's an ETF, if it's an index. What's really important, and essentially this is how law of large numbers comes into play, is that you create enough occurrences so that over time the probabilities take over. What we believe will be the next generation of trading is, and this will be the real differentiator, will be that we will be focusing as traders on capital efficiency more than we focus on anything else. You know, to this point in history, we've kind of focused on what is the underlying going to do, or how is the portfolio makeup going to be, things like that, and all the different allocations and how we apply and execute different strategies. But we think in the future, everything's going to boil down to, with market efficiency, everything's going to boil down to capital efficiency. How do we use our capital best? And I think one of the big takeaways from today's portfolio discussion is about the importance of capital efficiency. Okay, understanding that next after product indifference, after being product agnostic, you have to be capital efficient in your approach and capital efficient in how you use your money. With capital efficiency comes this concept, this new concept of portfolio allocation. And portfolio allocation as it differs from portfolio allocation for the past few decades. In the past, portfolio allocation was just different forms of diversification. Today, portfolio allocation is different strategies, it's different volatilities, it's different durations, it's different betas, it's different correlations. It is tying everything together and then being able to manage it from a single set of Greeks. And to think about everything from a much, from kind of above ground as opposed to being just on a level ground. And so I think it's really important when you start to think about portfolio allocation, that we think about it in kind of 2024, and we don't think about it as this is 1994, 2004, or even 2014. We are traders, and traders make assumptions. And one of the fun things about trading is making assumptions. Sometimes when we teach, we talk about things and we use kind of a concept of delta neutrality. And the reason we use delta neutrality is because it's easier to teach. But when we're actually trading, we're always making directional assumptions. There's nothing wrong with making directional assumptions. It's part of why we trade, because we can make directional assumptions. But what we found over time is that you can make directional assumptions, but you can tie capital efficiency into those assumptions. In other words, you can risk less, to potentially make less. You can risk less to make more in some cases, or you can take positions where you can risk a lot to make a little for a high probability of success. But all that comes with the underlying assumption of what's going to happen directionally. And directionally could be up, down, or nothing. Many of my assumptions are that market's going to be in a range, and that's a reasonable assumption as well. The other thing we focused on today is monitoring positions. And the reason that's so important is because we don't have a set it and forget it approach to trading. Our approach to trading is we're constantly monitoring, we're constantly adjusting, we're constantly making changes to our portfolio, we're constantly keeping things in line, we're constantly lowering our volatility risk, we're constantly lowering our delta risk. And because of that, monitoring your positions becomes a skill. It's kind of like an art form. We also do something that's very new to trading. It's new to the technology that we've built. It's new to the exchange technology that exists today. We have the ability to adjust positions with a single click. And we have the ability to adjust multi-leg positions with a single click. We have the ability to recenter and adjust positions, to roll and adjust positions, to roll and recenter, all with a single click, all instantaneously. We're talking about, sub 2 seconds. Because of that now, adjusting positions, which used to be something that was very difficult to do and very expensive, now becomes very cost effective because it lowers volatility and it reduces your outlier risk. It also gives you optionality with respect to taking off positions and managing positions early if you want to. The other thing that we focused on today was the importance of closing positions, adjusting positions, and rolling positions. And again, it's an important takeaway because a lot of people think that investing is put something on and take it off when it expires, or put something on and take it off when it gets to some number that you're looking for. The reality of what we found is if you want to reduce outlier risk and you want to give yourself the best chance for long-term success, and remember, when I say long-term success, the key to all success in the world of trading, business, entrepreneurship, whatever it is longevity. And in order to have longevity in the world of finance, you have to close certain positions when they're winners. You have to adjust certain positions when they're winners, or maybe they're not winners. And you have to roll certain positions to eliminate volatility and to reduce outlier risk. And the concept of closing, adjusting, and rolling is super important. And most people can't get enough of that information. And we focused on that today because we want people to really understand the importance of once you put something on, you've controlled what you can control. At that point, the underlying is going to do whatever it is that it does. Sometimes it goes your way, sometimes it goes against you. And the few chances we have to make adjustments to that, we have to take advantage of that because that's how we keep our mechanics in line. And then the last thing I want to just talk about takeaway-wise is, and you're going to see this in a second, is redeploying capital. And the reason that we redeploy capital is because the numbers don't necessarily work unless you keep everything going. If you don't have enough occurrences and you don't redeploy capital often enough, you don't have the ability to effectively predict your outcomes. If you do something once or twice or 5 times or 10 times, it's difficult to predict what's going to happen. If you do something 50 times or 500 times or 5,000 times, it is much easier to predict what's going to happen. And that's what we're all about. We're about putting the math in your favor and putting the mechanics in your favor, optimizing those mechanics. Okay, so this gets to the crux of what I wanted to talk about today. And that is, I want to build a sample $100,000 portfolio for you. I want to tie together everything everybody talked about. I want to tie together everything that all the other 5 speakers talked about. And I wanted to bring it together in a sample portfolio. The reason I chose $100,000 was because if you have $1 million portfolio, multiply by 10. If you have a $10,000 portfolio, you divide by 10. If you have a $50,000 portfolio, divide by 2. It's really simple to use it. So I used a $100,000 simple individual margin account. This is not portfolio margin. This is a combination of using stock, options, futures options, pairs trading, cash, and everything else. Normally, if we were building our own portfolio, we'd probably used about 60% of the capital. In a perfect world, in a perfect market, we use about 60% of our capital. In today's example, I'm going to use the full $100,000 because it doesn't make sense to have any cash left over. I want to give you a full $100,000 portfolio for something that you can walk away with, something that you can learn from. So this is a $100,000 portfolio for an active trader. This is not a passive market participant. This is for an active trader. And even active traders need to leave some money in cash reserves. So for argument's sake here, and you can say, hey, maybe it should be 20,000, maybe it should be 30, whatever it is. I used $10,000 as my cash number. So in cash reserves here, I left $10,000. Now I did that intentionally. And the reason for that is because I want to show you what do you do with cash reserves. And so you're going to see now as we start to go through the process of building, and I'm going to give you a heads up here, a little tease, there's going to be about 24 or so different positions that I'm going to incorporate into this portfolio, which is $100,000. Now, if you think about it that way, then you're thinking, well, that's about $4,000 a position. Okay, maybe that's in that 4% range. Some of these positions are going to tie up 1 to 2%, some maybe 0.5%, other ones obviously a little bit more than that. But $100,000 portfolio, 24 positions total. We start with 10% in cash. And we've never done something like this before, so I think you're going to really like it at the end, and you can go back and you can look at it, you can study. The names that I use are pretty relevant, but it just gives you an example of like the way we think. So the first thing you see here is with the $10,000, I split it up into 3 different underlyings. I put it into 2 ETFs, 2 cash government debt ETFs. One is BIL, and the other is SGOV. Now you can see here the strategy is long. There's nothing else to it. These are just ETFs. There's no commissions to trade in and out of them. They're penny-wide markets. And what I did here with the $10,000 is I said, okay, $4,000 into BIL. It's like a 90-day. It's almost the equivalent of a 90-day T-bill. It invests in like 30, 60, 90, 120-day T-bills. So it averages out to about a 90-day T-bill. In SGov, it's virtually the same thing. It's just a carbon copy, same thing, $4,000 into that, and then left $2,000 in the account kind of floating as a cash investment. That's your $10,000. There's nothing special about this. There's no pop because there's no risk to those trades. There's no credit received. There will be dividends. There's no SPY delta. There's no correlation. There's no days to expiration. There's no implied volatility there. Those are what those other columns are. BPR is buying power reduction. POP is probability of profit. Credit is the amount of money that we take in for whatever it is that we're selling. If we're buying something, it's a debit. If we're selling something, it's a credit. SPY delta is the share equivalent in S&P 500. Correlation is how correlated something is to the S&P 500. DTE is days to expiration, and IV is implied volatility. So in each one of these cases, the strategy is just a net long. It's just 4,000, 4,000, 2,000 for a total of $10,000. It's 10% of the portfolio. This is the cash piece. There's nothing special to this. It's just, this is plain vanilla. But we move on. The next thing is stocks. And in the stock world, obviously all stock trading now in the industry is pretty much free. It's all free at Tasty. But stock trading, I'm going to use 20% of the portfolio, or $20,000. Now, you know, one of the things I did with this portfolio is I didn't want to borrow 1 penny. So there is 0 margin. This is an individual margin account, but I'm using 0 margin. So stocks, using 20% of the capital on stocks, $20,000. You can use up to $40,000 if you want, because we obviously will lend you $20,000. Every brokerage firm will in an individual margin account. But I'm not borrowing any money here, just using full cash. And when you trade, just so you know, when you trade options, you trade futures, or you trade futures options, there's no margin. There's buying power reduction, but no margin. So you never borrow money for that stuff. The only thing you can ever borrow money for is stocks. And in this case, I'm not borrowing any money. So I'm just using $20,000 for stocks. They can be long, short, or both. I don't care. You can have a couple longs, you can have a couple shorts, you can do both, whatever. They can be growth paying stock. They can be growth stocks. They can be dividend paying stocks. They could be They could be index ETFs. They could be sector ETFs. Doesn't make any difference to me. This is 100% on you, totally subjective. This is your kind of directional assumption. The only thing I care about is that all are liquid and all are obviously marginable. So you can borrow up to 20K if you need to. I think in this case, you need a minimum of 2 to 4 positions. And again, I'm doing this as a sample portfolio. I just want to put you in a position where when you go back and you watch the tape or you watch this digital collectible and you say, hey, you know what, I need to go get a refresher. I just want to see how Tom broke down this portfolio. This is a portfolio I thought a lot about to make it very fair and to make it very easy to understand, even though it is anything but easy. And you'll see that in a few seconds. So minimum of 2 to 4 positions, or minimum max of 2 to 4 positions with the 20,000. What I did here is, these are all long stocks. And what I did is, since there's no margin, I only used $5,000 per stock, 5555. And again, the pop in these cases, these are just 50-50 shots, so we don't put pop in there. There's no credit received, there's no SPY delta in this case. I'm not really, let's put it this way, because I could be long or short, I'm not focusing on the SPY deltas here. The correlations, again, not important because these are completely objective positions. Days to expiration, it's unlimited. Implied volatility doesn't matter that much. I just mixed and matched of some stocks that I thought were cheap or interesting. So for example here, I used Intel, because it's on its butt at this current time, FXI, which is a Chinese large cap index trading in Hong Kong, because it's on its butt, TLT, which is a bond index just to have some non-correlated diversification, and BITO to give you some digital assets in the portfolio, because it's an ETF that's tied to Bitcoin futures. And none of these I have any kind of attachment to, love for in any sense. They're just trades. But I needed to break it up. I wanted to give you a long bias portfolio because most people understand that. And so I went with Intel, FXI, TLT, and BITO, $5,000 each. This is the very easy part of this discussion. These are the first 7 positions, 3 in the cash indices, 3 in cash ETFs and or floating cash, BIL and SGov, and then floating cash, and then Intel, FXI, TLT, and BITO. All the first 7 positions, this is the easy stuff. These are kind of the passive trades. There are 0 commissions involved in any of this stuff. You can mix and match. You can go long or short, anything you want. This is just an example. None of this I count towards directional risk or anything like that, because I just don't think about that way. And normally I would have some longs and some shorts and everything else. Now we get into the heavy stuff. So the first thing I want to touch on is futures pairs and futures options. Now, if you remember some of my takeaways from a few seconds ago, I talked about capital efficiency. And one of the ways to make a portfolio capital efficient, one of the ways to give your portfolio that like extra bit of alpha and that extra efficiency that span margining gives you, is to embed some future pairs, which is a directional trade. That's like long and short a future. That's long one future, short another. It's kind of, you're playing for a reversion to the mean in a divergence between 2 underlyings. And then in the futures option space. Now I'm only going to tie up $20,000. Remember, we've used $30,000 so far. Now we're going to use 20. It's going to take us to 50% of our account, or $50,000, and half of the money that we have. All of these trades that I'm going to show you right now in the futures world fall under span margining. Span margining is a different margining system, except on Tasty, it's all done on the back end, so you don't have to worry about any of it. But it can significantly improve capital efficiency because it affords the user a lot more leverage. And in this case, I'm going to choose to do a minimum of 3 to 6 positions, and I'm going to split that between defined and undefined risk. All the underlyings are going to be liquid, and all are going to have high IVR. As you kind of see that theme throughout everything we do, everything has liquidity, everything has high IVR. That's a really important part of kind of the foundation and the mechanics of everything that we do. If we're going to optimize our returns and we're going to optimize our approach to trading and building a portfolio, then products have to be liquid, and they also have to have kind of a little bit of an advantage, which is the high implied volatility, meaning we get a bigger expected move, we get bigger credits, and we have more capital to work with. So, as you can see here, this is where things start to change ever so slightly. And I'm going to give you a couple of examples here. The first two, I'm going to use the micro products, but in the process of using micro products, I'm also going to create some pairs trades. The first one that we're doing is gold and silver. And we call that, there's kind of this thing called the gold-silver ratio. And sometimes gold gets expensive relative to silver, sometimes silver gets cheap relative to gold, same thing. And so what we're doing in this case is we're buying silver and we're selling gold. This is a highly correlated pair. Obviously gold and silver move pretty close together. And so what we're doing here is we're taking advantage of high IVR, which in this case, since we're not selling any premium, doesn't matter as much. But what does matter is that the IVR is high, so the expected move is great. And in the case of this pair, what we're doing is we're using the micro products because these are fairly large products, and the micro products give us enough of a capital commitment. And in this case, I'm going to do this pair. You can see it says 1x. I'm going to do this pair one time. Now, the buying power requirement for one spread is $3,000. Okay, one spread, $3,000 fits into our range. The pop, which is the probability of profit, is 50%. Now, 50% is because it's a toss-up. We don't know which one. We obviously think silver is going to outperform gold, but we don't know. So it's 50-50. And then you can see the correlation between these two is 0.85. Anytime you do a pairs trade, you want a really high correlation. The next pairs trade we're going to do is we are going to buy 10-year yields. We're going to trade the yield curve. We're going to buy the 10-year yield again in the micro product, and we're going to sell the 2-year yield. We're going to buy the 10-year and we're going to sell the 2-year. And in the process of doing that, okay, we're going to do that pair 4 times because that pair, because there's lower volatility and spans based on volatility, it only ties up $3,000 in capital. And that has a 50-50 shot. That's a 50-50 shot pop-wise. And it has a correlation of 0.9. Now, what's neat about that is that many individual investors, or most individual investors, don't really get a chance that often to trade the yield curve. And what is exciting about this is I'm showing you how to trade a gold-silver ratio and a yield curve trade using micros built into a $100,000 portfolio, only using $3,000 in capital each. And those are directional trades because those do not have defined risk. Now with the rest of the futures capital, because I said we're going to use $20,000 and that only ties up $6,000, we are going to do some futures options trades. And in the world of futures options, we're going to pick the most liquid ones with the highest volatility, and we are going to pick trades that have possibly defined risk, or some might have defined and undefined risk. We'll see. So one of the things we're going to do, I'm going to give you a bunch of examples here. I'm going to actually pick 5 different underlying trades. We're going to do something in gold, crude oil, natural gas, the Japanese yen, and soybeans. The correlation between those 5 underlyings is virtually 0. And the SPY deltas, meaning like how much do those move with respect to the SPY, is also 0. So what happens here is we're focused on liquidity, yes, on all 5, and we're focused on pop. So the first one in gold, we're going to sell a short strangle one time. That ties up $5,300 with a 70% probability of profit. 47 days to expiration, a 17 implied volatility, and it brings in $2,400 in credit. It's a big credit. The next one is in crude oil. We're going to do a short iron condor, but instead of doing it once, we're going to do it twice. It ties up $1,200 total with a 55% probability of profit, bringing in $2,000 in credit with a correlation of only 0.2 and 36 days to go to expiration. The one thing that's nice about futures options is that they don't have standardized expirations, which sometimes make it complicated, but for getting diversification among different durations, it's really good. Natural gas is the next one. We're going to sell a naked put in there. Brings in buying power is one time in natural gas buying power is 2,300, and it brings in $670 with a 75% probability of profit. The next one is a short put in Japanese yen, ties up $1,600, 75% probability of profit, and brings in $500. And the last one is a short strangle in soybeans, ties up $3,000, has a pop of 68%, and a credit of $1,000, a correlation of 0.1, which is virtually nothing, 43 days to expiration, and implied volatility of 17. So using 5 different underlyings for commodity options, we're talking about a short strangle in gold, a short iron condor in crude oil, a short put in natural gas, a short put in the Japanese yen, and a short strangle in soybeans. That's a mix of defined and undefined risk. Those are a lot of non-correlated positions. And what's starting to happen here is at first we put on 7 positions, then we added 2 pairs trades to take it up to 9, then we added 5 more futures options trades to take us up to 14 different positions. Now we've used a total of 50% of our capital. We have $50,000 left, and we're going to keep moving forward. So now, with the remaining $50,000, we're going to use listed options, 50 grand. And we're going to use diversified underlyings, again, that have high IBR, no change. You see, that's why we're product agnostic. We can go from futures options to listed options to pairs trades, it doesn't matter. High IBR, decent volume, and a 65-35 split between defined risk and undefined risk. Okay, that's important because some people go 75-25, that's usually what I do, but some people like to be 35% undefined and 65% defined risk. It's up to you. There's no right or wrong answer. Everything is theoretically on point. So in this case, we are going to now look at a bunch of new positions. This is going to take us up for almost 9 new positions and take us up to 24 positions total and use the balance of our $50,000. And I'll go through this relatively quickly because you're getting the hang of building this portfolio here and you're seeing it on the screen right in front of you. But in this case, I did a short put spread in Baidu 5 times. I did a short put naked in Baba. Obviously, you see a theme here. I'm getting a little bit long China. In Apple, we sold a put spread. We shorted a put in Apple. In Intel, we also shorted a put. In Tesla, we sold a skewed iron condor, giving us a little downside delta. In Microsoft, we sold a call spread. In NVIDIA, we sold a call spread, mixing this up between longs and shorts. In IWM, because of high implied volatility, we sold a short strangle. In the SPX, we did a long calendar spread on the put side. In AMD, we did a wide iron condor. And in Google, we sold a short strangle. This is a combination of 65% undefined risk, 35% defined risk. And you can see the pop all the way down the screen, like 68, 65, 78, 78, 73, 67, and so on, all the way down the line. You can see all the different credits we receive. You can see all the SPY deltas, the correlations, the days to expiration, and the implied volatility. This is a true diversified portfolio. This is a non-correlated diversified portfolio with durations ranging from in the mid 30 days to the mid let's call it 50 days. This is a portfolio that's broken down between futures, futures options, cash instruments, ETFs, indexes, long stocks, basically everything you can imagine. There's a big move in the market. I mean, obviously the correlations will move towards 1, but you have about as much reduction in portfolio volatility and outlier risk as you can have building a $100,000 portfolio. But let's take it one step further. Let's tie this all together. So portfolio totals, and this is kind of the real takeaway at the end. The capital used, $100,000 total. The capital borrowed, 0. Important because we're not using any margin. Interest and dividends from the $10,000 cash to the dividends on the stock that I bought, about $1,000 a year, 1%. Okay, not a problem. The total number of positions, 24. I mentioned that a couple times. The average pop, which includes the 50-50 shot on stocks in the 50-50 pairs trade, so it includes everything, is 63%. Okay, 63% is your POP, that's probability of profit. That's not bad, including all your 50-50 stock bets and all your 50-50 pairs bets. The total credits received for this one trade, not for the entire year, but for this one trade, meaning this one series of trades that range from 35 to, let's call it 55 days, average of 45 days, is $15,785. The total SPY deltas, that means your total S&P directional risk on this portfolio, less than 7 shares of SPY. In a $100,000 portfolio, we would consider anywhere from 100 to 300 SPY deltas to be delta neutral. This has 7. This portfolio, in our mind, has no directional risk. The portfolio correlation to the SPY in total, the totality, is 0.33. Anything under 0.4 to 0.5 is considered to be a non-correlated or uncorrelated portfolio. That's what we've built. The optimal number of days to expiration should be around 45. This portfolio has 44 days to go to expiration. So we hit the optimal DTE, we hit the perfect portfolio correlation, we hit the perfect delta neutral as far as SPY deltas go. Now, our POP's really strong at 63, all total. Annual redeployments, 8. If you take 44 days, you multiply it by 8, that's how many times a year. Remember how I talked about how important redeployment was? You can do this 8 times a year. Now, this is going to be perfect world. This is nothing bad happens. So this is like best case. I'll give you a best case and I'll give you a worst case. Best case here is you pick up about $125,000 over the course of a year in annualized credit received. What you keep on that $125,000, we say on average, you want to keep around 25% of that. So let's just say the expected return range for this portfolio, which is not a risk averse, it's not a passive portfolio, but it's not a risk averse portfolio. In this portfolio, you keep somewhere between 22 and 31%. That's the target. Now, why is that interesting? Because the cash alternative, meaning the risk-free cash rates right now, are 5%. So if your risk-free cash rates are 5%, then what you want to do when you're building an active trader portfolio is you want to create a portfolio that has a return of some multiple of risk-free rates. What's a reasonable multiple of risk-free rates? Well, some would argue 3x, 15%. Some would argue 7x, 35%. Some would argue 4. So I picked a relatively conservative number at 22%, let's just say on the low end, 31% on the high end, which is the amount of money I think you need to make to take the risk involved in building this whole portfolio out and building this whole trade. So when you put this all together, now, is this the best case? Sure. But we can't present anything else other than, hey, things happen. Sometimes stocks win, sometimes something bad happens. Sometimes everything goes your way and it's even better than this. Who knows? What's important is not the actual names. What's important is actually not the actual returns. What's important is understanding how to build a portfolio that has some multiple of risk-free rates as an objective so you understand why you're doing this. Nobody takes all the time, all the resources, and all the money to make 2% better than a risk-free rate. If you're going to spend the time, you're going to commit the capital, and you're going to the energy, the resources, and everything else that it takes, you have to have an objective that is some multiple of risk-free rates. That's what this portfolio is. It is a portfolio for active traders with an objective that is reasonable, that makes it all worthwhile. My name's Tom Sosnoff. Thank you so much.